Hi. After the production function, we have next chapter cost theory. What is cost? First, we should know because cost, as the sequence, if you look into it, we have looked about the demand function. Then we have looked at the production function. Now we are looking the cost function. So when we talk about the demand function, what is the demand existing? We must know. Then we must know what will be the cost of production and production function. Now we look into the cost, that is, what will be the expenditure that will be incurred. What is cost? Cost is the expenditure incurred or deemed to have been incurred. This is the definition of cost. What do you mean by that? Suppose you buy this pen, you spend 10 rupees. So 10 rupees is the cost. Suppose you start, you innovate and make a startup of app by yourself after completing your engineering or MBA whatsoever. When you start the app, there is no one, no employee, nothing. You have started your own. Where did you start? In your own building. It may be your own building or rented building. Do you pay to yourself for doing that app? No. Do you pay to the rent for the building? No, because it's your own building. You are living already in your own house. You have innovated or started that startup. So we don't record those as expenditure in accounting. But in economics, that means while taking decision, because you are going, you should be the decision maker. If you are taking a decision, you must not only look to the actual out of pocket expenses you have incurred, but you must also consider the costs that are deemed to have been incurred. That's called implicit costs. For example, as I have mentioned just now, your payment to yourself. Payment to yourself, if you look into it, you need to look into the payment made is okay. Without making payment, will you pay to yourself? No. So you consider as if you are not starting this app, but you are employed somewhere. So there is a alternative cost for that. That also will be considered. We call that as imputed costs. So cost meaning has to be understood in a broader sense. So let us look to that part into it. So the first, in economic concept of cost, unlike traditional definition tends to focus on explicit cost only or historical cost only. In economic approach, we consider cost that emphasizes on opportunity cost. Opportunity cost is defined as cost of foregone. What did you forego? You have alternative decisions. If you take decision 1, you are foregoing the decision 2. If you take a decision 2, you are foregoing the decision 1. So that is called opportunity cost. So when you take this, let me explain. So opportunity cost is the cost foregone. The best measure of cost of consumer product or factor of production is what must be given up to obtain that product factor. The opportunity cost of any decision is the value of the next best alternative that must be foregone. For example, you want to use your factory premises for research and development. What do you get? By spending your factory time, factory supervisor's time, gangman's time, workers' time, all entire factory is engaged in R&D. What will you get? You are producing product with for the future. So future products are being produced now. Research is going on. So this is decision 1. Suppose you don't give it to the R&D, but you produce normal product. What do you get? You get immediate output and you get immediate sales. So immediate sales is one decision. Future for sales is another decision. If you take one decision, you are foregoing the other. If you go for R&D, you are foregoing present production and sales and profit. If you take a decision to produce the goods now and make money now only, you are foregoing future products. So somebody innovated Covaxin recently. So they must have spent a lot of time in their factory. So only after investing time in the factory, they were able to do it. Right time they have released and they are making money. So you have to, it is a dilemma which decision to take. If you take X decision, Y is the foregone. If you take Y decision, X is foregone. What is foregone is defined as opportunity cost. So that is the concept. And you have explicit and implicit costs. What you spend from your pocket explicitly, what that goes outflow from your factory is called explicit cost. You spend money and you have, it involves actual payment of money to the parties. Some if you don't pay, like opportunity cost, or if you don't pay but you impute the cost, that is called imputed cost. That means cost is not incurred from the pocket you pay, but you assume that you have paid to yourself and then write the account. That is called imputed cost. So when you take these two into account, I'll just show you an example. You will understand. Suppose the price of a product is $5. In economic approach also, sale price is same, $5. Less wheat input. You have purchased it about 1 month or 2 months back at $3 1 kg. So you purchased $1. Then comes $3 you have spent. But within a month, the price of the wheat has gone up to $5. Now you have two choices. Number one, don't produce anything. Just sell the wheat in the market and make money. 1 month back you purchased at $3. Today it is $5. So sell the wheat in the market to the outsiders, make 5 rupees, $5 as a money. So this is one choice. The second choice is you spend further on, let us say, labor and others. You get $1.5 you spend. So total expenditure will be 4.5. Deduct 4.5 from 5, you are making a profit of 0.50. This is as per the accounting normal, common sense, layman's understanding. But what economists will say is, you are not getting a profit of 0.5 on each product, but you are incurring a loss of 1.5. Because had you not made this product, instead you would have sold the input as it is to the outsiders, then obviously you would have got $5. Then you would not have incurred another 1.5. So this 1.5 was a loss. You would have got the money 0.5 as such. So this is the difference between economic concept and this concept. Yeah, one important point in the cost we must understand is normal profit is also part of the cost. What do you mean by this? In getting a normal profit is acceptable even in communist theory. That means even in Russian economy, communist economy, Chinese economy also, getting a normal profit is a part of the costs. Only when you earn supernormal profits, we call them as it is not part of the cost. Let me explain to you. Because all opportunity costs must be accounted for, proper concept of cost includes normal payment of inputs. What are the inputs? Land, labor, capital, organization. For land you pay rent, for capital you pay interest, for the labor you pay wages, and for the organizing you pay some normal profit. All four put together is the cost. Hence, normal profit is a part of the cost according to the Alfred Marshall economic concept. Economic profit is over and above that. If you get over and above that, then only we call it as economic profit. And according to the economics theory, only in monopoly organization, which is protected by the intellectual property rights, you will get the economic profits. Or where there is through the law, you prohibit others from entering into the market, you get the profit. Otherwise, in a perfect market, you don't get more than normal profit. So normal profit and cost, unless otherwise stated in managerial economics, cost includes explicit cost, implicit cost, and profits as such. So this is a basic concept you must understand. Now we come to the marginal and increment costs, wherein you have some sunk costs. When we talk about three concepts are there. Sunk cost. What do you mean by sunk cost? As the meaning suggests, it is the sinking cost or sunk cost. Suppose you have entered into an agreement with the landlord that you will uh, that you will landlord will be paying rent every month. You will be paying rent to him. Let us say 40,000. 40,000 rupees you are paying every month for 2 years. Whether you use the building or not, it is immaterial for him. You have entered. The signature is made and you have agreed. Suddenly, lockdown was declared. So, 3 months your unit is closed. So, you could not even enter. I think many of you must have heard in Visakhapatnam, where the factory was not allowed to go. The factory man was not allowed to go for 1.5 months. And that is the reason there was a blast. That is a different story. But 1.5 months you are not gone there, you are not produced anything, nothing you produce, still you pay rent because it is a sunk cost, because you have already entered into an agreement. As per agreement you are paying. So what happens in this case is, for example, a warehouse is there. For $1,000 you have taken lease and you are not using, and you know that you are not going to use for another 8 months. So for 1 year there is no use, but we have to pay lease because we have agreed to it. In such case, somebody comes and says, I will take your warehouse for $800. I will pay you $800. Then will you say that it is a 200 loss, or will you say 800 is profit? See, 1000 is a sunk cost. Don't look 1000 minus 800. Look 800 as a revenue income. You are getting where you don't expect a single pie. So subleasing during that time is a right decision, rather than don't say minus 20, minus 200. Okay. So let us look. That is called the sunk cost. Then we have another concept known as marginal concept. Marginal concept, as we have defined in marginal productivity theory, marginal means additional. Cost of producing additional output is called marginal cost. What do you mean by that? A change in the quantity will make your cost also to increase. If you want to produce 1 unit extra, Q1 to Q2, you are increasing the output, then price also, the cost also will go up. So the cost, that additional cost which you are incurring to produce additional unit, is called marginal cost. So whereas incremental cost is similar to that, but both are not same. While the marginal cost is the cost of producing additional 1 unit, increment cost is the extra cost you are incurring because of your policy decision. Let us say you have agreed to take over one firm. So after taking over of that firm, how much extra you are incurring, that is called increment cost. So increment cost and this both are not same. Cost of long-lived assets. See, assets which are there for a longer period. Yeah, longer period if you have it, what happens, for a longer period, if an asset is there, we would still record cost minus historical cost minus depreciation. But latest trend is, what is the market value? At market value, you must find out. And if you take the market value, there may not be any value at all. You don't get anything. Then you must make it zero. So that is called long-lived assets have to be assessed and revalued. So these are the basic concepts. In our next class, let us see how these cost curves will appear. Thank you.